So we've got a lot of regulation changes coming up now on the 28th, which have been in consultation with the industry now for a good period of time from the FCA. And we are looking at how that will change things moving forwards. And the main changes around that are the commission models, which are certainly applicable in the motor finance space. So traditionally, we've had models which have allowed dealers to sell through a range of different rates, and the regulator, in consultation with the industry, has now sort of moved to more of a single price point in many ways to try and take away some of the flexibility, but also just to make sure that there is a consistent consumer interaction with motor dealers that they have. So what does that mean for us? That means overall a simplification of some of the quite complex arrangements that were in place. What we are experiencing is that many dealers are now moving to a single fixed rate for their customers, and just making sure that's very clear and consistent in their showroom, in their advertising, with what they're doing. So for the finance companies, there's a logistics of making sure that we move everyone over to that single rate ready for the 28th of January, and sort of doing that. And what we are also seeing, and what the FCA have also stated that they're quite keen on, is more lenders now moving to a rate for risk model, so being able to evaluate more the individual customers based on their credit profiles and where they are. And I see we are seeing a little bit of a polarization of consumers. Many of us have seen numerous surveys now where the savings rate for many customers has actually gone up. They have less expenses. They're not spending money going on holiday at the moment. So they've actually got more disposable income, but unfortunately then you've also got consumers who have been significantly affected by it, or worst case lost their jobs, and of course are affected detrimentally through the pandemic. But what we are seeing in terms of changes of behaviours is some of them are quite obvious. Yes, people are buying a lot more online than they ever were. And we are now seeing that in the motor trade as well. We've seen a good number of B2C type organisations now entering the market. So we've had Cazoo, Carzam, Cinch are now in the market and advertising quite aggressively at the moment. And consumers are now beginning to get more and more comfortable with that model. Whereas 2-3 years ago, people wanted to go to the showroom, they wanted to have that experience and touch the car. Now they are quite comfortable. A lot more people are comfortable with that car being delivered and having 10-14 days to work out whether they want it or not, and to do that. So that's a big cultural shift for us in how consumers are looking at buying cars. In terms of documentation and the ease of it, it really links into a number of things we've spoken about this morning in the regulation being clear and consistent to our consumers. We've had legacy issues in banking around PPI. There's certain conversations around gap insurance now as well, and we've just got to make sure that customers have a very clear and consistent journey when they are buying financial products. It's as simple as that. And for us, when we entered the market 18 months ago now, it was a key thing that we wanted to make sure that the value-added products that our consumers are purchasing were very clearly laid out on the documentation. They understood their rights if they wanted to settle one of their value-added products but keep the main car loan, they're able to do so. And it just gives consumers that absolute flexibility in their purchasing, and understanding the makeup when they drive off the forecourt or when they have that car delivered at home. They understand the exact makeup of what they are paying for each component of the transaction that they are having. On electric vehicles, we are seeing again a consumer shift in electric vehicles in 2020. And as an example, in December in the UK on new vehicles, we had a 15% market share on pure BEVs, battery electric vehicles, and that meant the year ended up at about 6.6% in the UK. And for comparison, it was 1% in 2019. So we are seeing a significant movement around it. Sort of linked to my previous answer, I think there's probably less mileage anxiety than there was around electric vehicles now, which might be moving certain people across to that sort of part of it. And if you look at all plug-in hybrids, it was just under 24% in December. So almost 1 in 4 vehicles in December was a plug-in electric vehicle of some form or another. But we're not alone. I think in terms of our wider global BNP Paribas family, we have the joy of seeing other markets and how they move. And Paris was the same. Paris were just under 20% electric vehicles in December, so slightly ahead of us. But we're also seeing big changes in China and the market. In many ways. I think we're here to operate, to support the industry, of course, to lend money as a financial institution, and we are now looking at various tools in the marketplace just to make sure that we can evaluate consumers in absolutely the right way, because as we've said earlier, there will be people who are probably in a stronger position than they were before, but there's also a lot of people who are in a very difficult situation, and we've got to make sure that we lend responsibly through that, and we are very clear and keen on our affordability checks that we do as a responsible lender within the industry, and we just make sure that people don't overstretch themselves at what could be a more difficult period for some. So I think we're comfortable with what we're doing. I think there will be a good gradual growth as people get more and more confidence as we come out of the pandemic, and the vaccinations increase as we go through this year. But we've got to be very careful as a lender and a responsible lender at that we lend responsibly and to the right people, which is affordable to them at all points.